Hello everyone and welcome to the YouTube channel of BeingACCA. This is Tushita Gupta, ACCA affiliate, and in this video we are continuing with our FM Pre-September 2024 mock exam, and we are getting started with the very first section B case study over here. Alright, so now let's get started with reading the scenario and then we'll be answering the questions also. Ernst Company is a well-diversified company that has successfully grown over the years by adopting the strategy of inorganic growth. The three acquisition opportunities have been identified as follows. Small company manufactures parts required for automobiles. The extract from its statement of financial position are given to you over here. The non-current assets includes a goodwill of this much. The other non-current assets, okay, this is about the non-current assets. Medium company is an unlisted company engaged in manufacturing of parts in the aerospace industry. So we have all sorts of financial information given to us for three companies over here. Now let's get to the very first question. Why is the valuation of equity for a company necessary? Now let's have a read at the questions. The company is planning to raise equity finance in the primary market. This is absolutely correct. Whenever you are well-diversified company, you're looking for, diversifying your operations. Obviously, you might, have to raise finance from the primary market. So over here, valuation of equity will be necessary. Now, if you see, there's nowhere over here the name of the company mentioned. The Ernst & Company is not mentioned in the scenario over here. That's why this is a generic question. That's how you identify in the exam whether it's a generic question or it is based on the scenario. Since it does not say the name of the question over here, it is a generic question. So definitely equity valuation will be needed if you plan to raise equity in the market, because you'll have to, present your numbers. You'll have to exactly show to the public how are you valuing yourself, and then only they'll be willing to invest in your company. That's the first statement, proven correct. The company wants to establish the terms and conditions for mergers and acquisitions. Absolutely correct. Whenever you're going for any merger, whenever you're having an acquisition done, then obviously you need to value the company, because what price are you going to set if you are merging a company, who pays who how much, and similar for acquisition. So obviously valuation of equity will be necessary for mergers and acquisitions also. Coming to the third statement, the company has a primary focus on mission-driven activities and no profit motive. This is not correct. Whenever you talk about, any companies are never not-for-profit organizations. Those would be NGOs, those would be public sector organizations, but never a company. So they do not have a no-profit motive. Rather, companies do operate for making the sole motive of, generating profits. That's why statement 3 is incorrect, and we get to our answer as option 1 and 2 only. Moving further to question number 17, over here it is asking you to calculate the asset value of small company using the NRV basis to the nearest of thousands of dollars. So we all know that when you talk about the NRV method, the net realizable value method, you take the net realizable values, how much ever you will be able to get if you go out in the market and sell those things. That is what you include in the valuation. So as far as non-current assets are concerned, let's read the information also. They include a goodwill of 250,000. Now, whenever you are calculating using the NRV method, you will always ignore goodwill. So you can see over here, I'm using this calculator. All right, so I'll type in the figures. It's 1275, and I have to subtract $250,000 of goodwill. So that leaves me with 1025 as my non-current assets. Further, it says that the non-current assets are considered worth 80% of their book values. So I need to multiply this by 80% also, so that I'll be able to arrive at the net realizable value. So this gives me 820. I can either remember this or I can type it out over here. If you're going for center-based exams, then you need not do this. You'll be given pen and paper on which you can write these figures. Coming to inventory, inventory is worth 280. Let's read what does it say about inventory. The inventory is net of an obsolescence provision of $40,000. So that means the inventory is worth more, but we have subtracted 40 from it just as a provision. Going forward, the obsolescence should be brought down to 20,000. So 40,000 is what we have subtracted, but we want to give it back 20,000 because, we have made an over provision. We do not need such a provision. This needs to be brought down to $20,000. So 280 is the value. We have created a provision of 40. So I'm adding back 40. Now I want the provision to be 20,000. So I subtract 20. In net effect, I will be left with 300,000 as the value of my inventory. So I'll note this down here. This is my inventory. And then receivables are 520,000. It's mentioned over here. Receivables are expected to yield 90% of their book value. So 520 multiplied by 0.9, I'll be getting my answer as 468. Now we just have to add these three values and then we'll be able to arrive at the final answer, 300 and 820. 300 plus 820. So we arrive at our final answer of 1588. 000 is already given, so we just have to input 1588. And here is our answer. Now let's move further. All right, calculate the market value using the PE ratio method of the ordinary share of medium company to the nearest of 2 decimal points. So you have to calculate the market value using the PE ratio method of the ordinary share. So that means you have to give your answer in per share terms. Let's read the information about medium company. This is an unlisted company engaged in manufacturing of parts for the aerospace industry. It earned a PAT of 850,000 during the year just ended. It has 1 million ordinary shares, nominal value of $1 each in the issue. A listed company engaged in the same sector has posted an earnings per share of 1.2 and the PE ratio is 10. So how do we calculate the market value using the PE method? We just simply take the EPS and then we multiply that by the PE ratio. So over here, how are we going to do our calculation? Is we are going to take, first of all, the total earnings of the company, total, to arrive at the EPS. So total earnings are 850. I'll take it after tax. So 850,000. And this needs to be divided by 1 million. So this gives me 0.85 as the EPS. So I'm going to use the PE ratio as given for the similar industry to be 10. So it gives me a value of $8.5. So since it has asked me to 2 decimal points, I'm going to put it as 8.50. Moving further to the third question, the fourth question of this scenario. Which of the following correctly represents the value of Alpha's startup using the discounted cash flow basis? So here's the information about Alpha. Alpha startup company is engaged in software development. Its new software is becoming fast popular and the market seems to be promising. The cash flow projections for the coming year are given below. So these are the years, these are the cash flows that they are expected to get. And post year 4, the cash flows are expected to rise by 2% perpetually. Cost of capital estimated is given to you. So you have to work out the numbers over here. Let us first find out the present values for year 1, 2, 3, and 4. So I'll be using this calculator over here. For the very first year, my cash flow is 130. And this needs to be multiplied by the discounting factor. So this is also provided to you in the exam. This is how you navigate to the formula sheet. I need the present value of 11%. This is 0.901 given to me here. So I just multiply this with 0.901. So this gives me 117.13. I'll note it down over here with me. I'm not using any Excel because the previous time I did my calculations over Excel. So students were asking me, will they also be getting the Excel? So no, you do not get Excel in the exam. That's why you should not be putting yourself into a habit to solve section B questions on Excel. Now 180 and the factor over here is 0.812. So this needs to be multiplied by 0.812. So this gives you 146.16. I'll again note this down here, 146.16. Then moving to the third year is 210 multiplied by 0.731. So this gives you 153.51. All right, and last but not the least, you have 240. So 240 needs to be multiplied with the fourth year's figure is 0.659, 0.659. So this is what you get. And now you add all of these figures. 153.51 plus 146.16 plus 117.13. So this is what you will get the value for the year 1 to 4. Now we have to use the perpetuity formula. So I'll note down my total value from year 1 to 4 over here, which is 574.96. And then I'll also find out the perpetuity value. So for the perpetuity, I have a simple formula. I will use the dividend growth model formula over here. I have last year's cash flows are 240. These are going to be rising by 2%. So multiplied by 1.02. And then you divide this by your cost of capital, which is given to you as 11% minus the growth rate, which is 2%. So this gives you your denominator as 0.09. Now you arrive at 2720 to be the value of perpetuity. Now this is still the value at the fourth year. So you need to discount it back to bring it to today's time. So you're going to find the value of the perpetuity by taking out the PV. So let's have a look at the discount factor. You are presently at the fourth year, you want to come back to 0. So it's going to be into 0.659. So this needs to be multiplied with 0.659. So this is what you will get. And then you add what you had earlier found out with respect to year 1 to 4. So you add 574.96. So you will get your final figure as 2,367,000, which will be the closest to this one over here. So we mark this as our answer and we move further to the very last question, which is related to this scenario. Which of the following is the correct way to calculate the market capitalization of a listed company? So we all know market cap is nothing but your number of shares multiplied by the current market price. So this is, I think, the very first statement over here, number of ordinary shares in the issue multiplied by the current market price per share. So this is very simple, just asking you the definition of market cap. With this, we are done with this scenario over here. In the next video, which follows this, you're going to see the solution of the second section B question of the FM Pre-September 2024 mock exam. Thank you so much for watching. I hope that this was useful.